All right, guys, we got the FOMC meeting today. Yeah, we got the Fed meeting going live pretty soon. In less than an hour, we'll get a timer up. We'll get some music playing here. Let me get the... Let me know how the music is right now, because that's going to influence the audio that we have during the actual press conference. We got the Fed rate decision coming through live in about an hour. We'll get a timer up. I got these big headphones because I've started connecting it to my computer. Let me know how the sound goes. Sound should be pretty good. Yeah, we're good there. Yes, sir. How's the music? Is the music good? Fed's gonna cut rates 25 basis points, almost certainly. Almost certainly. We'll do a poll here live in a second too. Sound is good. What about the music? Can you hear the music? Will the FOMC have a hawkish or dovish tone during the press conference? We asked this question this morning as well. Hawkish or dovish? What do you guys think? What's up, Goose? All right, so the U.S. Senate has enough votes to pass that $859 billion defense authorization bill. Voting continues. Barclays' annual bonus is expected to increase as much as 20% according to Bloomberg. Hindenburg Research are shorting Sezzle, S-E-Z-L company. The U.S. Supreme Court is going to be hearing arguments in ByteDance and TikTok's bids to pause a law that would force the sale or ban of the TikTok application. And the Dow's fallen down a little bit. The NVIDIA chart, we got NVIDIA and Tesla up. I should have the NASDAQ. My bad, guys. Here's the NASDAQ. In fact, we'll put the NASDAQ up on a top step X here. Let's put this up. Whoa. Yeah, so we'll put the NASDAQ up here. Again, we're green on both accounts here on the day at least. I'll be trying to frame this right so it's not too big but not too small either. There we go. We got the NASDAQ up there at the top. We'll put a couple things on the right side here. What do you guys want to see on the right side? We can put like the dollar index, maybe gold. Put gold up on the right. Put like the Dixie up here as well. These are all things that are going to be heavily influenced by this rate decision. And you know what? I might actually be able to zoom in a little bit too here. Let me try to do this. That's better. Rally is over. There's probably a short report on X. This is going to be my best FOMC ever. I heard that people were looking for dovish sentiment, but see people hawkish. Maybe. Let me check the Hindenburg news. Why the heck does this thing keep popping up, dude? I don't want that to pop up, bro. How do I disable that? I don't know what this is. Is this? No. Is it this that keeps popping up? Is it this? I don't know what that is that keeps popping up. John, what did you do today? Well, I live streamed since about 6. After I live streamed, I worked on a video about strategies in my system that I'm going to debut after the FOMC video. So we're going to have a strategy video debuting after FOMC. And then I scheduled FOMC, played with my dogs for a little bit, and now I'm back here. So that has been my day so far. Yeah, gold's still down some. Hindenburg Research. Let's take a look if they posted anything. Yeah, Sezzle, a failing, quote, buy now, pay later platform playing short-term tricks as insiders cash out via stock sales and margin loans. So yeah, Hindenburg did put out a new short report on a company called Sezzle here. Looking at the company Sezzle, they're down a huge percentage. Yep. Down looks like about 60%. Or no, not quite 60%. They're down about, what is that, a third? They're down 30%. I haven't even pulled up Discord yet today, guys. Not even pulled it up Discord. So no, I didn't do BJJ. I don't have time. What is this on my face? What is that? I'll whack myself here. What do you think about supermicro semiconductors? I think it's risky. What time is the Fed meeting? The meeting is in an hour and 20 minutes. I'll put a timer up. That's true. I should put a timer up. Ugh, I need some water, dude. I forgot to get some water. Oh, there's the timer. Okay, so we actually got a timer up already. Let me squeeze this in there. Where's supermicro semiconductors? Somebody's talking about that. I mean, you know, they got booted out of the... They got a new auditor, independent auditor, which is good. Then they got booted out of the NASDAQ, which is bad. So I'm kind of like neutral on supermicro. I'll be right back. I'm going to go get some water. Guys, I need some water today. I'll be right back. Okay, so we're back. Honestly, the stereotypes of people in the South are absolutely true. All right. Like, we drink everything out of jars here. We really do. I mean, look, cheers to you. This one actually has... Oh, no, this one... Some of them have a honey tag on it, but we drink everything out of jars. Not moonshine. Actual water. Whew. All right. Gatorade sucks. Water's better. All right. Hi, dear. What do you think of Tesla will... What do you think Tesla will short squeeze or crash? What you got is telling you. I don't know. I mean... In order to crash, something bad would have to happen. company-wide. I don't know. I think either one of them, I mean, I think it's probably going to go up over time because they're involved with full self-driving. I'm from Louisiana, but I'm in Texas right now. Currently, it is a 1:15 Eastern Standard Time. We got 47 minutes. Chat, 47 minutes until the Fed does their interest rate decision. So at 2 p.m., they're going to announce their interest rate decision. At 2:30, they're going to do the accompanying press conference for it. Chat. And so again, you can kind of see. Honestly, we're pretty accurate. Here's the Fed's countdowner. I'm pretty sure this is a little bit early. For whatever reason, they have it early. Currently, we're at 99 to 1% chance likelihood of a rate cut. So we're at 99 to 1. We're almost certainly going to cut rates. We're almost certainly going to cut interest rates. So, yep. Almost 99 to 1. You know, it's about 98.5 to 1.5 technically, but it's pretty probable we're going to be cutting 25 basis points today. It's super improbable that we're going to do anything outside of that. Where did this big red splotch on my face go? Jiu-jitsu probably. Maybe I got bowed in the face. I don't know. Is the Fed announcement going to create a price impact on Bitcoin? Yeah, a lot of the streamers covering this don't actually understand the Fed. You know, like a lot of people don't understand the FOMC. And like they're just kind of pretending, you know. They know it gets views, right? So they try to cover it, but they don't actually understand it. Some of them do, right? But a lot of them are just, you know, bandwagon jumpers, to be honest. This is definitely not the most important Fed decision, right? They might frame it that way, so you know, you go watch them. But like, I'm here to tell you the honest reality of it, and this is certainly not the most important Fed decision, right? The most important Fed decision was probably a couple months ago when we had cut rates for the first time, depending on how the market would react. This is just another rate cut. So that's something you got to understand about it too. It's just another rate cut here. And at this point in time, it's almost certain that we're going to cut rates 25 basis points. Now, we'll see how the NASDAQ and the SPY and the S&P react to it. But it's pretty probable that we're going to cut rates 25 basis points. Right. Now, outside of that, what matters most here is how Jerome Powell sounds during the actual press conference, right? So what Jerome Powell says during the press conference means more than anything else, right? He's going to get interviewed. They're going to do a Q&A, and we're going to live stream the entire thing fully right here as it happens. And so we're going to live stream all of it live as it happens. But again, the most important thing is we're going to cut 25 basis points. So that's kind of a neutral outcome. That's what everybody expects right now. Listen to what Jerome Powell says. If he's optimistic, if he's pessimistic, if he's hawkish, dovish, restrictive, easing, that's what you want to listen for. You know, yeah, so honestly, you want to hear buzzwords like recession, inflation, elevation, recession, depression risks, what future outlook looks like in terms of rate decisions. You know what I mean? Like all that stuff, right? Like that's all stuff you want to pay attention to and listen to Jerome Powell for, right? So just tune in. It's big, but don't listen to anybody if they act like, why does this keep popping up, dude? Why? Like I click that. Go away, dude. How do I stop? Let me side click this thing and disable it. Stop it. Side click it, it doesn't do anything. Oh, you jerk. Okay. What I need to do is not go over that. Just say they cut more than 25. Just say they cut 50 to 75. They're not going to. They're not going to, right? Like they're not going to cut more than 25 basis. I mean, listen, Jerome Powell's typically pretty balanced. He's not going to shock markets. And if you're watching anybody that's telling you that they're going to cut 50 or 75 today, whoever you're watching genuinely does not know what they're talking about. Again, watch. We're going to cut 25 basis points. It's not even going to be a shocking thing. The market might not even move that much from it, right? What matters more is what Powell says, and we're going to stream the entire thing live. Again, if anybody's telling you anything outside of a 25 basis point cut, they truly don't know what they're talking about. And I would caution listening to them because it means they're pretty new, paying attention to economics, to be completely blunt about it. But, 'cause, 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 My best memory of trading was last year when I watched your FOMC and made my first profitable trade. So now I always come back to you. Hey, thanks, Eric. Appreciate you, brother. Hopefully you keep making money, sir. We'll see. All right, we still got 40 minutes left here, so we still got a lot of time. Yeah, I mean, the economy's not in some super weak stance in which a rate cut, like a big rate cut, is justifiable right now. Like, if inflation was super elevated still, and you know, we saw losing GDP or even like worsening GDP quarter to quarter, or, you know, massive spikes in unemployment, like those are all justifiable reasons to cut rates more aggressively than 25 basis points. But in the Fed's mind, right, like they got to look at the risks associated with both. Like, we can't just continue to cut rates with no consequences. If we do, inflation will spiral out of control. And so they want to do it in a balanced approach, right? But anything can happen. It's not that they can't cut rates 50 basis points today, or they can't cut rates 75 basis points today. It's just looking at it so that you guys at home understand the actual probabilities behind it. Like, the people that operate the FOMC Fed watch tool that I showed you guys a second ago, like, they know what they're talking about here. Like, this is big money involved with this. Like, making these expectations, this is big money involved. And everybody wants to be a contrarian thing, and that's all good and fine. But if you let that desire or desperateness to become contrarian overpower your logic, that's what makes a bad trader, a bad economist, right? Like, in the end, these are incredibly probable outcomes, right? Like, we're almost certain to do 25 cut, and it's not even like it's not really a debatable thing, you know? And so that's why I kind of go back to the point, if you're listening to somebody and they're telling you today that we're going to cut 50, 75, they truly just don't understand economics, mostly. I mean, and again, I'm saying this, and I might back myself into a corner on the one instance in which we shock people and actually do something outside of the expected thing, but it's just such a low probability outcome. Nobody should be telling people that's what we're going to do, because the probabilities are so far against it, if that makes sense, right? Even if I'm wrong, right? It's still the most probable thing. Let me look this up. Yeah, so AI has this wrong. So AI says the last time... See, this is where AI runs into trouble, right? Is because AI said the last time this occurred was in September of 2024. The FOMC implemented a 50 basis point rate cut. Leading up to the meeting, the watch tool indicated that market predominantly anticipated a smaller 25 point reduction. Again, this is actually incorrect. So I covered the September meeting. If you looked at the CME watch tool 20 minutes before the Fed decision, they said 50 basis points. 50 basis points was like a 60% likelihood 10, 20, 30, 40 minutes before the rate decision. Now, these are subject to change. You know, these can always swing back and forth in the weeks preceding the FOMC meeting. But if you look at it 30 minutes before the FOMC decision, it's almost always right. And the other thing to understand is that when it's this polarized, like when it's 99-1, this is so unlikely. This is so unlikely today. It's never something that you want to bet on or go into it expecting for sure. Yeah, the cut's priced in a long time ago. Even, yeah, Jerome Powell doesn't want to shock the market. He just doesn't. Jerome Powell's going to initiate the Santa Claus Rally 2025 bull market confirmed. Yeah, or a market correction. Who knows? What does probability mean? Do you genuinely want to know what probability means? The likelihood that something happens? Probable means it's likely something happens. Powell will move markets more than the rate. Even the Fed doesn't want to surprise people. Yeah, what Powell says during the conference is going to move markets more than the rate decision. Again, it's just super unlikely we're going to do anything outside of a 25 basis point cut. And so in that regard, it's kind of a neutral outcome. And it's not really something that we should expect like big volatility from. It's just much more probable that we're just going to cut 25 and we'll see what happens afterwards. Right, for sure. He just wants to leave a good legacy. John, is it probable that the market will never go on sale? Of course not. The market's eventually going to come down. Right, eventually we are going to crash, you know. But again, like, you know, people look at this. I think people are desperate to be right in markets, right? I think they really want to be right. And if somebody predicted to crash 3 years ago, 4 years ago, they're kind of keep holding on to that hope that we're going to crash, right? The problem is like, okay, say the market goes up like this. And say somebody called a crash right here, right? And then we crash here and come down to here during the crash. Are they right? Of course not, because we didn't even break underneath where they called the crash, at the bottom of the crash. And so, right, like if you throw darts at a dartboard, eventually we're going to crash. Like that's an inevitability. It's the quote Thanos, right? It's inevitability. Like we're gonna freaking crash eventually. The issue is over-prediction of crashes, and that's very common. People wildly over-predict crashes. Michael Burry, you know, obviously over-predicts crashes, but people over-predict crashes too. And the biggest edge in the market is that stocks are going to go up over time, over long term, you know. And so, you know, you got people that are blinded by political bias, by the need to be contrarian, by all these different things, and they're missing out on the biggest statistical edge finance ever gives you, which is that long term markets are going up. You know, when in doubt, zoom out. Long-term markets are going up regardless of whether we crash or not in between those periods. And so the problem is people hold on to this need to feel like they have some secret information that nobody knows, that they're going to predict the next big market crash, and it's romanticized to a super heavy degree in which it blinds people to the biggest statistical edge the market ever gives you. That's my issue, you know, is that people are just taking the lowest probability thing in markets for no reason. That's not a good analysis, John, bro. Well, explain why and we can talk about it. Yeah, the big pullback's coming eventually. The question is how much and when does it come, and who knows, right? In the end, the people who lose the most during those big pullbacks are people who get emotional and sell. The people who buy into those big pullbacks are people who do the best, and trying to predict those big pullbacks is a losing game, usually. It's so rare to be able to do it successfully that when a group of people actually do it successfully, they make a freaking movie about it. Like The Big Short, right? That's how rare it is, you know, but everybody thinks they're going to be the next Michael Burry short market predictor. You know, they romanticize it and think they're going to be the next big guy. And that's why you got all these influencers out here telling everybody the market's going to crash every other week. It's because they just want to be that guy, you know. And they let their desire to be that guy overpower logic sometimes, I think. But maybe they're right. I don't know. Maybe we do crash. I think we might correct a little bit next year in 2025. I think we're up freaking 100% in 2 years on the NASDAQ. It's a crazy amount. And eventually we're going to come back down. A little bit at least. Not all the way, of course, but eventually we're going to drop some. Jerome Powell with a bow tie, dude, that would be chaos. He's almost like, I kind of joke around, what color is this tie going to be? I'm going to vote purple. And the reason I vote purple is because it's almost always purple. It's almost always a shade of purple. It's either like deep, like mauve. My wife told me the color was mauve, by the way. It's either mauve, I think is the way, I don't know, let me know if I'm pronouncing it wrong. Or it's like a lavenderish purple. Yeah, if he came out with a bow tie, market's going crazy. Market's going crazy. Without a tie? Ugh, dude. Mauve? Yeah, that's what I said. He'll never wear red. The reason he won't wear red is because it's too indicative of direction in finance. At least that's my guess, right? That's what I'd like to believe, is that Powell knows people pay attention to his ties, and he doesn't want to be indicative of a direction. And so he's never going to come out with a green tie or a red tie, because there might actually be a correlation with oh, is it mauve? Did I say mauve? Yeah, I don't know, guys. Listen, I don't know colors. Do y'all really think I know colors here? My wife had to tell me it, and I even got it wrong still, so don't judge me, okay? I'm not the top 3 best color analytics person in the world right now. All right. Cheers to you guys. The rate decision is at 2 p.m. Eastern Standard Time. We might have a timer in the top left over here. I'll put the timer right next to me, actually, so we can point to it easily. This will most likely be the last cut for the next few months. Yeah, an interesting thing. So we're actually expecting a pause next month in January. 80% likely of a pause. Now, this might change depending on inflation data. And remember, tomorrow we have GDP data. And so a scenario that could happen, I'm not saying it's probable, but it's possible. A scenario that could happen is if inflation spikes on Friday. We have core PCE data on Friday this week. If we get high inflationary data, worse GDP tomorrow, weak unemployment numbers and payroll numbers next month, that's the scenario in which we could pivot from a pause in January to another cut, right? If the economy shows weak economic reports in terms of CPI, PCE, GDP, unemployment, payrolls, that's a scenario in which we might actually pivot to a cut. If we show good economic data in terms of all that stuff, then we'll still probably pause next month. But that's the scenario in which we cut again. John, I'm only following your investments and I'm up 300% this year. Hey, congrats, Alden. Do not copy me, though. I'm not an investment professional. And I'm not liable if you lose money. Always make your own assessment, trade responsibly. I have no idea what I'm talking about, guys. And I might be wildly wrong about anything and everything I say. I do trade off stream. You're not going to see all my trades. I'm not an investment professional. Don't sue me, is what I'm trying to say here. You're not going to win because I disclaim everything. So, cheers to you guys, but do not copy me. All right, anyways, we'll see if we cut rates next month as well. We'll have to watch the economic data leading into it. $25 basis is bullish. I mean, it's neutral, I would say. What's your opinion on gold day trading? My opinion on gold day trading is I'm not good at it. Yeah, for sure, right? If it was 65, 40, 35 or 55, 45, that's different, Kai. But it's not, right? It's 99-1. You know, in that regard, we're not going to do anything outside of a rate cut when it's this likely. I mean, we could, and maybe I'll eat my words. I don't think I will, but anything's possible. Nothing's definitive, I guess. We could shock markets. It's just super, super low probability. Yeah, if he raised rates, it would be chaotic. Market would dump, you know. Some people would be happy with it, though. I think it would be a little bit, yeah, some people might like it. I don't know. Day trading is hard, yes sir. Day trading is. They all would come out the woodwork, I told you so. Bro, you better believe, dude, I've talked so much smack on crash predictors because they've been wrong. In the end, they've just been wrong, right? Like, they've just been wrong. Like, the people who genuinely thought we would crash this year are genuinely too wrapped up in politics. The likelihood that we're gonna crash during an election year, super low, right? But you better believe when we finally do crash, it might be next year, it might be the year afterwards. Even though I'm telling people I think we might correct next year, they're gonna come out acting like they told me so, because they told me we might crash 4 years ago. I guess that's how it goes when you put yourself out there in public. Good news incoming? I don't know. I don't think there's any good news. I think it's just neutral. I think we're going to cut 25 basis points. I think Powell's going to come out here and say we're going to take a data-dependent approach. Inflation is looking better, but still somewhat elevated and over the 2% inflation target. That the labor market's showing signs of a resiliency, and that we're going to take a data-dependent approach and not cut rates super aggressively if we don't need to, but time will tell, and blah, 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 right? Like, that's basically what's going to happen today. I'm telling you that's going to happen right now. I could be wrong, but I don't think I am there, and I think that's almost certain what's going to happen. Anybody that watches these meetings every month, every 6 weeks knows that's usually what happens. The timer is for the actual rate decision in 27 minutes or so. Yeah, or John the politician, Bro, this little red splotch on my head is kind of messing with me here. I don't know where it came from, dude. Look at this splotch. What happened? Did I get whacked? Did my dog, headbutt me or something? Don't let this Fed meeting distract us from the fact that John Jones is ducking Tom Aspinall. Honestly, I genuinely agree. I'm not even mad at him for it, though. Listen. John Jones is the greatest of all time. He should just retire. I don't think he should fight Pereira. He's bigger than Pereira. He would just... What I have an issue with is fans of John Jones, pushing and getting weird about, pushing the much more predictable outcome fight in John Jones versus Alex Pereira. Everybody knows how that's going to end. Why push that? Who cares, right? Everybody knows John's going to wrestle him down, submit him in 20 seconds. And so why push that fight? It's so much more predictable. Tom Aspinall versus Jones is going to do bigger numbers than Alex versus Jones would ever do, right? And everybody knows that. But, they push the Alex Pereira fight like it's somehow a better fight, and nobody thinks it is. It's just weird, right? Just to agree with Jones. It's just strange. I'm okay with him, right? He's the GOAT. And so I'm okay with him getting paid for it, too. I just don't like him looking at Pereira, because everybody knows how that fight's going to go. No, everybody knows who Tom Aspinall is, bro. That'd be like if Khabib wanted to fight Mighty Mouse, because nobody knew who the real contenders were, right? It's well, yeah, I guess so, but you're already much bigger and, stronger than Mighty Mouse, so it's kind of like a cheap call out. Anyways, market's getting really choppy, really flat here. Crash coming. Don't get my mind. And Crash says it looks terminal, bro. Of course it isn't. About to ask AI, hey, I got a red splotch on my forehead. What does this mean? Honestly, I'm genuinely curious now. I'm doing it. Hold on. It's not terminal. I'm going to put it out there in the world. It's not terminal. I'm perfectly healthy. I'm going to live until I'm 100 years old. That's all I'm saying. Okay. Skin irritation, allergic reaction. It says put some salicylic acid or benzoyl peroxide on it. Could be a heat rash or sweat irritation. Eczema. Yeah. I mean, pretty standard, I guess. It's coming from aliens. Yeah, I heard the New Jersey news about aliens today. I did hear that. All right, guys, we got 23 minutes. All right, guys, we still got 20 plus minutes left. I'm gonna put it in sub only mode. I don't think I've done this yet. Oh, we are in sub only mode. I thought when I scheduled the stream, I thought I set it to not sub only mode, but I guess it is. So hey, I guess that's all right. John is trying to tell us to short the market. Bro, I use soap, dude. Honestly, I train jujitsu, bro. I promise. I probably shower at least once a day, every day. You know, I have to use soap too. And so usually what happens is I get up, I shower before jujitsu because I'm kind of OCD, and then I go to jujitsu and then I shower immediately afterwards. And then sometimes I even take another shower / bath later on in the day too. I'm definitely one of the top 3 most voluminous bathers in the world right now. All right, guys. NASDAQ at 292. Let's see if it holds. You didn't mention soap. I have to use soap, bro. I use tea tree oil soap usually, but I use a mix of different things. Don't judge me, all right? Yeah, the water bill definitely shows it. I talked about my water bill last week. My water bill is like $500 a month, and I'm not even lying. You want to see my water bill? I'm serious, dude. Like, look. Let me look at it this month. I haven't looked at it this month because I'm kind of scared to. Let's find it. All right, guys, we got 20 minutes. Let me know what you guys think. Will the Fed be hawkish, dovish? Will the Fed be restrictive or easing? Will they cut 25 basis points or do something outside of expectations? Let me put gold up here. Yeah, my water bill's $500. Like, look, y'all don't believe me? It's $486.50. Look at that. Not even lying. All right, guys, here's gold. Gold at 26.50s. 20 minutes left. Are you trading now? No, I'm waiting. Is this a room full of Wall Street flunkies or legit investors and traders? I mean, if I had to categorize myself, I'm definitely one of the top 4 biggest Wall Street flunkies of all time. You know, like if I genuinely had to classify myself, that's what I would classify myself as. Some would say I'm top 3, you know, but I'm definitely not good at as a trader or investor or day trader. And you never want to copy me because I have no idea what I'm talking about. All right, with that said, though, we're going to cut rates 25 basis points, and then I think Powell's going to be very neutral. I think he's going to say we're data dependent. We're going to take a data dependent approach. Yeah, I think he's going to be data dependent approach. We're going to play it by year. You know, we're not going to cut rates super aggressively if we don't have to. Inflation is still above the 2% inflation target. You know, it's still somewhat elevated. Labor market's resilient and strong is what he's going to say. He's not saying there's no risks. There's some risks, but things look okay, and we're going to take a data-dependent approach. Again, I'm here to tell you that's probably what he's going to say. I always could be wrong, but I guess I hope he's a little bit more dovish now because it means better for market reactions, but... Y'all are still worried about my water bill? I mean, my house isn't small. And we have a pool, you know. But I don't know if it's $500 a month. Big. But yeah. America has a strong economy. Yeah. Yeah, it's not super hard to predict. Are you going to cover MU earnings? I'm not going to stream them. MU's just not a big enough company. I've had a lot of people ask me that though. It's making me think maybe I should. But yeah. Yeah, I'll put the SPY up. Here's the dollar index. SPY at 605. Market's very flat today. I told you guys would probably get chop. And not a shock that we get chopped today. I don't pay attention to small caps, not really. I pay $14 a month in Portugal. Oh, that's good. I usually trade the NASDAQ, micro NASDAQ, futures contract, sometimes gold, sometimes micro Bitcoin. Where's Bitcoin at? Speaking of that today. Bitcoin at 104K. Damn, Manny, I need those type of bills, bro. Do you have a pool? What's your water bill by volume? My daily use is 1,354 gallons per day. It says compared to my past billing period, it's up 62%. Which would mean that like we're at about 800 gallons a day. Last bill. John, you're the best. Thank you for all you're doing for us streaming. Thank you so much. Y'all gotta help me pay my water bill. That's why I'm here, you know. Return of the leak. Yeah, listen, I'll talk to we've had plumbers come out here. All right, guys, but seriously, 15 minutes left. We got 1,500 people here. Well, I opened myself up to it, Allison, so it's all good. I told him my water bill was high, and so, you know, it's all good. I also bought Alibaba today because I do think live social shopping is going to get big in the US. It's big in China right now. I think it's going to get big in the US, and it's at a period in which not a lot of people know about it. But it's already got some, you know, real numbers behind it for live social shopping. And so I was looking at ways that I could potentially get involved with that, and Alibaba was one of them. So in 15 minutes, we have the Fed rate decision. Yeah. Yeah, I know PDD. PDD's down 2 on the year. The speech is at 8:30 or 2:30. I mean, you can see the timer right here. So this is when the actual decision happens. And then the speech, you can see it in the big yellow bold letters up there. Again, hit the like button, hit the notification bell. We appreciate the love. Thanks so much. Yeah, I think live social shopping is going to take off in the US for sure. But I don't know when, but I'm trying to just get on the front of that. You know, I'm sure it'll directly influence like Meta, Microsoft, maybe Amazon here in the US. But those are too weighted to the rest of the market as well. So, like, I'm not as confident in investing in them. I think Alibaba's a little different. I don't like Alibaba because the government there is a little bit more, what's the word? Authoritarian. But I do think Alibaba is one of the biggest companies there, even with all that said. And I think it'll be one of the ones that gets picked up on live social shopping. It just depends on when. Newegg? Yeah, maybe. Gold news buy or sell. Well, gold's been down a little bit. If we look at gold on the top right, gold broke all-time highs back in October. It's still been pulling back. It hit 2750s earlier this month, but it's kind of been pulling back for the last few weeks. So we'll see. Gold sometimes moves in a macro way with markets, but it also could move the opposite of that. It's just a little bit more in a longer term view, gold moves with markets. Short term, it can go for against like the NASDAQ, the S&P, the Dow. So we'll have to wait. All right, chat, get ready. We got 12 minutes left. 12 minutes. Fed decision is going to be at 2 p.m. Eastern Standard Time. It's almost certain going to be a 25 basis point cut. We're here to tell you it's almost certainly going to be a 25 basis point cut. Again, we can look at the probabilities, but I'm here to tell you that's probably what we're going to be. January is an interesting month because it looks like we're going to pause in January. We're currently at 4.25 to 4.5. And again, this is percent, right? So you move the decimal, you move a decimal places 2 places over, and that's the percent. So this is 4.25 to 4.5% for short-term interest. You know, currently today we're expecting a dump down or a cut from. See, look, the percentage has changed a little bit here. See, that's a little bit interesting. Watch me eat my words and have us do something like have us actually pause today, which I think would be a shock. But I guess it's possible. But this percentage changed a little bit. I wonder why. Typically, they know what they're doing here. But this percentage did change a little bit just now. I looked at it like 5-10 minutes ago. It was 99 to 1. Now it's 97 to 3. I mean, we got 11 minutes. I guess anything could happen. I hope he shocks the world and we can crash so we can finally gap fill. Tired of trying to buy these lifetime highs. It would be bad. Yeah, I mean, it would probably dump the market down, you know. But I mean, it might be better for inflation long term if he did pause. I still don't think it's probable, but it's possible. Yeah, if he pauses, the market's probably going down. I'm not saying he's going to. It's still pretty outside the. It's almost certainly not going to happen, but anything's possible. We'll see. Yeah, pause would be bad. I agree. And we'll see what happens here. It'll be fun to see what happens with the Fed decision. Yeah, again, I mean, like, everybody's acting like this is some crazy, you know, FOMC decision, that it's going to be some wild thing, that everybody's, again, look, I'm going to be real. Nothing crazy is about, unless he shocks the world and does a pause, which is 97 to 3 right now, it's just not going to be some, like, super wild outcome, in my opinion. Do y'all really think it's going to be some wild outcome? I mean, it's almost certain we're going to cut. It's not one of the more polarized, like, odds FOMC meetings, right? It's just people acted like this is the craziest FOMC. I'm sure they title everyone that. But, again, they're just kind of, they're sensationalizing it. They're being a little dishonest, I think. But, hey, we'll see what happens. I think if nobody watches these and they don't really understand economics, they might think that, you know, that this is some wild, you know, decision, FOMC decision. But it's, again, I'm here to tell you, is it nothing? No. Is it something crazy? We'll see. Yeah, make sure you hit the live button. You can also hit 2x trading to catch back up on the stream chat. So... yeah, we'll see what kind of, like, comments he gives, what kind of tone he has. It's what's called a tone. So we'll see what the tone is for Jerome Powell, right? And what that means is, like, hawkish means a restrictive monetary policy. So the Federal Reserve controls interest rates. For those that don't understand what this is, the Federal Reserve controls interest rates. Now, they might raise interest rates, lower interest rates, and they control short-term rates, but eventually it trickles into long-term rates. It directly influences adjustable rate loans and mortgages, as well as home equity lines of credit and short-term lending. And so if the economy is looking super weak, or if they want to save us from a weak economy, they'll cut interest rates down. They'll lower interest rates. This stimulates the economy, unlocks cheaper access to loans and money to people, and they tend to spend it, and that stimulates the economy. They could also play the other side where they raise rates, which obviously makes money less accessible to people and causes less spending and ultimately helps combat inflation. So depending on what the risk is, whether it's inflation or economic weakness, that will influence what the Fed chooses to do. Today they're expecting to cut it 1/4%, 25 basis points, which is 1/4%. And the odds of that today are 97-3 currently. So 97-3% likely that the Fed is going to cut rates 25 basis points. Again, 25 basis points in that regard is a neutral outcome. It is what's overwhelmingly expected by most major banks, analysts, all that good stuff, right? It's what's overwhelmingly expected. But with that said, if they don't do that, if they don't do what's overwhelmingly expected, then it'll kind of be a jolt, like a shock to markets. And so it's something that you definitely want to tune in and pay attention to. It'll be like a jolt, a shock to markets. And so that's what we want to watch. We got 5 minutes left. I just have to open the gate real quick, guys. I'll be right back. I just got to open the gate real quick. Yeah, so sorry, my daughter's here. Your timer is 15 seconds late. Is it really? Let me see. Okay, yeah, you're right. My timer's a little bit late. I'll fix it. All right, guys. So we got 5 minutes. Let me see. Yeah, we got about exactly 5 minutes left. There we go. All right, so this is almost exact. 5 minutes left, chat. 5 minutes. Yeah, so this is the NASDAQ futures contract. Carol top 3. This is my daughter this time. So Angelique, so we actually looked at the odds of that. Angelique says it's funny how bullish. Sorry. It's funny how... I'm choking on water over here. It's funny how bullish rate cuts are. They used to take markets if they had to make a rate cut just a few years ago. Now we soar. So this is the standard of that, right? So if we cut rates in a period in which the market is already in a super weak state economics wise. So if the economy is already really weak, if we're facing a recession or depression and we cut rates, typically it's seen as a desperate measure in which the market reacts negatively to it. So like 2020, desperate measure, market reacted negatively to it. 2008 financial crisis, desperate measure, market reacted negatively to it. If we cut rates as a preventative measure where the economy's still doing okay and it's just kind of preventative, that is typically where markets react positively to it. And I would label today exactly that, which is like the economy's not weak, unemployment's under 4.5%, GDP's almost 3%. The economy's not in a recession right now, right? And so I don't think right now is that at all. I think right now we're seeing a preventative measure, which is typically when the market reacts positively to it, but it's never 100%. And today's rate cut is overwhelmingly probable. Like we're almost certainly going to cut rates 25 basis points today, and it's already baked into the market, I would say too. But I have no freaking idea what I'm talking about. Not an investment professional. Don't copy me. All right, we got over 3,000 people here. We still got a few minutes left until the actual Fed decision goes live. All right, guys, here we go. FOMC decision. You guys ready? Whew. All right, we got 2 minutes left. Can we break 4,000 people here today? Let's see. Y'all hit that subscribe button. Bravo, nice, easy to understand explanation. Hey, thank you, DG. I appreciate it. Again, I'm with that said, I have no freaking idea what this is going to do today. Guys, no idea. Y'all be careful today. Be safe. All right, we're at 605s right now on the SPY. NASDAQ's at 301s. Gold is at 2652. You guys ready? We got 2 minutes. 2 minutes. This timer's almost exactly right. This will determine Santa rally or not. Possibly, yes. Give this guy a like. He never misses. Hey, thanks so much. And we're gonna stream the full press conference live as well, chat. So we're gonna stream the full thing live like we always do. All right, guys. You guys ready? Whew. Be ready here. We got a minute and 20 seconds, chat. A minute and 20 seconds. Again, we're going to stream the full press conference too, chat. Be ready. And honestly, you can kind of figure out what happens because based off of the market reaction. And again, I'll show you where it is. We'll also read the report here as it happens here. So you can kind of see this is where it's going to show up right here at the bottom at 17:18, 17:18. Again, we have 45 seconds left. 45 seconds left. The next report will show up underneath here. You see how this is HTML here for November 6th and 7th. This one will show up here at HTML same way. As well as, guys, remember, we're currently at 475 to or 450 to 475. And so that's how you can kind of gauge this, guys. All right, we have 30 seconds left. 30 seconds. Yeah, it's going to be a 25 basis point cut, almost certainly. And so let's get this out the way, and we'll watch the market responses here. Here's the gold chart. Here's the SPY chart. Let me get myself out of the way so it doesn't block. Here's the SPY on the left, NASDAQ on the top, gold on the right. So here we go. All right, here we go, chat. And my timer's a little bit early, but that's okay. And here's the report. Market's down. Not much, though. All right, so yeah, it was a 25 basis point cut. 25 basis point cut. I'll go ahead and read this. Recent indicators suggest the economy has continued to expand at a silent pace. Committee decided to lower the target range of the federal funds rate a quarter of a percentage point, 25 basis points. And again, I'll go ahead and read this. Recent indicators suggest that economic activity has continued to expand at a solid pace since earlier in the year. Labor market conditions have generally eased and the unemployment rate has moved up but remains low. Inflation has made progress towards the committee's 2% objective target but remains somewhat elevated. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Economic outlook is uncertain. The committee is attentive to the risks of both sides of its dual mandate. In support of this, they decided to cut rates 25 basis points. I'm going to pause this. In considering the extent and timing of additional adjustments to the target range of the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risk. The committee will continue reducing its holdings of Treasury securities, which is quantitative tightening here. So they're still going to continue quantitative tightening by reducing their Treasury holdings in agency debt and agency MBSs. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In addressing this appropriate stance of monetary policy, the committee will continue to monitor the implications of it. Okay, so yeah, 25 basis point cut, and honestly, the market is negatively reacting to it here. So I told you guys we would cut rates 25 basis points, but who freaking knows how the market's going to react? And look at the market reacting negatively to this here, even though this is what's overwhelmingly expected. So look at this here, chat. We are cutting rates 25 basis points as expected. I'll put this up on screen. Yeah, so I'll put this up on screen, but yeah, 25 basis point cut. Now, remember, all right, so the FOMC cut rates 25 basis points. I'll put that big up on the screen here. They cut rates 25 basis points. Again, the market has negatively reacted to it. I tend to think we might bounce back some after this drop. This isn't the biggest drop. We're actually still, like, the SPY is completely flat on the day, so it's not like we're super red or anything. Gold is negatively reacting to this here, chat. Look at gold. Gold's dumping down. It's at 2640s right now. 2640 is here. So a big negative reaction for gold, a negative reaction for the NASDAQ, a negative reaction to the SPY. But again, I told you guys I thought we might bounce back. Sometimes there's a very famous saying with these reports, guys, and it's the first move is sometimes the wrong move. I'm not saying we're going to rebound all the way back up, but in general, sometimes that happens, and it's something that, like, it's a nuance of markets that we look for sometimes, I think. But again, I told you guys 25 basis points. Now we're going to stream the full press conference, chat. So we are going to stream the entire press conference completely live. Live as it happens here, chat. So we're going to stream the entire press conference. Yeah, we're going to stream the whole thing live. So again, stick around. We're going to stream the full press conference. I'll put the timer up here. So again, we'll put the timer up. Also, guys, if you want to help support your boy here in this channel, check out Top Step. This is we're going to have a video debuting today about it. But Top Step is the best way to learn day trading. Almost all day traders lose, and I'm biased because I get paid by them. Almost all day traders lose money. And so if you try to risk your own money, you're probably going to lose, right? No matter if you put up 5, 10, 15, 20, 30K, you're probably going to lose it if you fund your own account day trading, especially in the beginning. Most day traders lose. What Top Step does is they give you kind of a middle ground where you can pay $49 a month. It's a monthly subscription. That's your risk. If you pass their testing, they fund you $50K to $150K with a 90% split. The base one is $49 a month. And you got to make $3K in profit without losing $2K on a $50K demo. And they've paid out over $150 million in the last 4 years. They fund thousands of traders. And in the futures market, there's no PDT rule. You can day trade the S&P, the NASDAQ, the Dow, the Russell, gold. Patterns are super similar to blue chip stock patterns. And so it's kind of the best of both worlds. It limits your risk, but it also teaches you how to trade under pressure, which is an important thing. If you want to check them out, they're an affiliate of mine. I'm biased because I get paid by them. So understand I'm one of the top 3 most biased traders of all time ever in the world. I get paid by them. Understand CFTC 4.41 hypothetical or simulated performance have limitations, guys. Top 3 plugs, shameless plugs in the world right now. But now that I'm done with that shameless plug, you can find the link in the description. Markets coming back down to test this bottom range here. We're still not down a lot. But again, the Fed cut rates 25 basis points. I'm curious to see if the rate cut odds for next meeting changed a little bit after this. So again, let's take a look. So again, here was the previous meeting. It was 97-3, and we ended up doing the 97% likelihood. Now we have to look at January here. In January, the odds of a pause next meeting actually went up. So again, this is a pause. Currently, we're at 425 to 450 right here. So currently, we're already at this the big tall one right here, 425 to 450, which is 4.25% to 4.5% interest. And now it's pretty likely that we're going to pause, that we're not going to change this at all. Markets are also breaking down a little bit here, guys. Look at the market flush right now. So markets are actually breaking down. I'll put the music back on so we got something to listen to until the actual Fed meeting here. And I'll put a timer up. We got 24.5 minutes left. All right, guys, market's flushing here. Look at this. Interesting. Wow. Hey, thank you, Sam. I told you guys, like, there's nothing really super shocking about, like, this meeting. Everybody acting like it's the craziest meeting of all time. You know, they're just trying to get you to click on the video, guys. Be smart. I don't like to be manipulated, so I try to be honest with people about it. But yeah. Why is the Russell crashing? I don't know. NASDAQ's down a lot. SPY's falling down too. Is it time for the big correction? Where's Bitcoin at? How did Bitcoin react to this, guys? I'm curious. Bitcoin down to 104, but not much. Oh no, this is nowhere near a Michael Burry crash. Like, look, guys, let's put a long-term chart up. This kind of gets, like, people who've predicted crashes for months, they want to be right? So every little drop, they're going to act like they're right. Here's a 15-minute chart. You know, like, we are literally right here now. We've gone up, pulled back, you know, like, acting like this is the end of the world when we've done this. It's kind of silly, right? It's a little bit too early to tell, though. We'll see. I mean, listen, we could correct. I told you guys I thought we might correct next year. Maybe it'll be earlier. I don't freaking know. I'm going to get rid of some of these support levels. I got too many. This is mostly from day trading. But yeah, market's certainly not liking it. Markets are down a lot. And to be honest, it's big money influencing it. You know, because like you got to understand this, okay? The Fed, anybody that understands economics already knew that we were going to cut 25 basis points. And so who do you think is causing this drop? Right? Big money's causing this drop. Everybody already knew we were going to cut 25. And again, it doesn't mean we're not going to rebound, but it doesn't look green at all. See what color Powell's tie is. I call him Towel. January will confirm. Papa Powell speech will make the losses go away. Maybe. Momentarily bearish. That's all right. Exactly. Yeah. I mean, maybe we keep going down. I don't know. If you throw darts at a dartboard, eventually we're going to hit it. Maybe now's the time we crash. I don't think it is, but it's possible. Usually I buy up stuff like this too. But we are down, you know. What color is Powell's tie? And again, stick around. We're going to stream the full press conference, guys. We will stream the full press conference live. Let me copy this and do another one. And paste. Duplicate. Yeah, again, the full press conference will be streamed live here at 2:30 p.m. Eastern Standard Time. We'll put this up on the bottom so you guys can really see it. Yeah, there we go. That's probably good, right? All right, full press conference streamed live here at 2:30 p.m. Eastern Standard Time. John, can you mauve? Is it not mauve? What is it? Maud? Is it Maud? Is it mauve? Sorry, my dogs are barking. Yeah, gold is down big, guys. Gold is down big. I don't know what the color is. Top 3 least color experts in the world right now. We're definitely crashing, yeah. So where is it, the speech? Jay Powell always makes it worse. Opinion on the 10-year bond rate going up. Yeah, so we can look at the 10-year treasury thing here, chat. So we can look at the 10-year rate. So we can look at the 10-year rate. So look at the 10-year dumping down. The yield is falling down fast. It's at 2630s here, 2630s. So the yield is coming down. So typically yields go down with interest rates. Right, so if interest rates are cut, yields are going to go down. So this is not an unexpected outcome here. And again, just to put this into perspective, generally mortgage rates move down with the yields as well. Right, so if yields go down, mortgage rates typically go down, and that's a good thing for them, I guess. Yeah, again, guys, we got the FOMC meeting going live soon here in 18 minutes. 18 minutes. We also have a video debuting with a premiere after this. So we do have a premiere after this stream, guys, so be ready for that. Yeah, we're going to stream the whole thing live as it happens. Powell will pump. Yeah, maybe. Yeah, we got 18 minutes or so. Again, the press conference starts at 2:30. Mauve. Moave. Is it really? Jerome coming to calm the markets down. Yeah, I mean the market's down a little bit. I wouldn't say it's like an end of the world scenario though. you know. Last FOMC, the market did go up. Yeah, typically the markets are very balanced. So typically markets are very balanced. We are in for a correction. Maybe now is a good time. Do we correct? Let me ask people. So I asked people this earlier, and I'm looking at the vote. I asked people, will the FOMC have a hawkish or dovish tone during the press conference? 65% think hawkish, 35% think dovish. I'm not going to take any trades right now, not based off of this, no. I tend to be a bull on big pullbacks like this, but who freaking knows? Like, it might go up, down, sideways. I really don't know. Also, guys, join our Discord. Our Discord's completely free, doesn't cost a penny. Everything we do is free. We don't have any paywalls behind anything. So join our Discord. Here it is right here. Also, follow me on X at Beginner Trades. At Beginner Trades is my X handle. Do I have a handle for Twitter? Let's try it. Follow me on Twitter too, at Beginner Trades. There it is. Yeah, follow me on Twitter at Beginner Trades. There's the link right there. Formerly known as X. You can tell it's old because now it's Twitter. It must be said that it's obvious the market has likely already anticipated it over the past few months. After the overheating, we inevitably need to cool the market down sooner or later. I'd keep going. Yeah, I mean, you know, it depends on how you look at it, right? Cooling in what way? I'm cynical. Yeah, we're in a huge bull market. There's no doubt it's going up historically dimmer. Yeah, so typically we have what's called a Santa rally. 80% of the time, I did the probabilities of a Santa rally over the last 20 years. Over the last 20 years, 80% of the time, we have a Santa rally. 80%, which is a crazy, you know, high amount, to be honest. Still, you know, yeah, still, it doesn't happen every year, right? So there's always a chance that we don't get a Santa rally, but 80% of the time we do. What is a Santa rally? Leading into the holiday, again in the US and everywhere, I guess it's on the 25th. Leading into that holiday, generally the S&P, the NASDAQ, the Dow run leading into the holiday, and sometimes afterwards, right? It's called a Santa rally. It doesn't always happen though. Again, it does not always happen. Why do treasuries always go up at the moment of the cut news? Because lower interest rates. Okay, so here's the rule of thumb, Roger. Okay, with bonds. Okay, yields follow rates. Okay, so if rates go down, I'm sorry. Is that right? Let me see. So mortgages typically follow yields. So if yields go up, mortgage rates probably going up, but yields are actually going down and rates are going down with it. Yeah, so that's correct. So rates are going down, rates are cut 25 basis points, and so in that regard, yields are going down with it. So yeah, that's correct. Sorry, I got in my head about it. But yes, interest rates and yields have a positive correlation generally, right? Mortgage rates especially. So mortgage rates follow yields, and yields are influenced by mortgage rates in different ways. But rates are cut today, so what's happening to yields? The TNX, like the 10-year as an example, is going down. It's pretty predictable. Yeah, hit the live button next to the play button. You'll fully catch up to the stream. We appreciate it. And again, if you want to check out my sponsor here, guys, I'm doing pretty freaking good. I got a video debuting after this stream about it. Here's my profit graph on Top Step X. What I've been doing is I've been locking myself out every freaking day until 9:30. And so I only trade after the opening bell. I bought a new computer. They're giving me all these weird like pop-ups. No, I don't want to use your new editor. But look, that's my profit graph over the last 3.5 weeks, right? You can also see this here. All right, you can also see this here. These are my winning versus losing days. The red are my losing days. And so again, this is on Top Step X. The big good part about Top Step X is that there's no commissions, right? So you can day trade the S&P, the NASDAQ, the Dow, the Russell, gold. No commissions. You can see 0 commissions, tiny amount of fees per trade. And so you can take one micro contract. You can see I made 11, 15, 13, 13, 2, 26, 10. Still net most of that profit with almost no commissions. The biggest edge in funding right now. And again, Top Step gives you a demo. They test your skill with it. Base one's $50K. You make $3K in profit without losing $2K following their rules. Reasonable 3-to-2 ratio. They fund you $50K, 90% split. You get to keep your first $10K in profit as well. It teaches you how to trade. And coming from somebody who lost thousands in my first month or two day trading, this is important. I still think most people will lose because most day traders lose regardless of where they go. It's a lot cheaper to lose on Top Step. If you pass it, you get a 90% split. That's similar to funding your own account, less risk, right? They paid out millions and millions of dollars. It just makes sense. Again, I'm biased. They're an affiliate of mine. You know, this is my second plug on this stream, so don't get too mad. I'm doing about a plug every 45 minutes. If you don't like it, cry about it. But if you want to check it out, here's the link. Great way to help support the channel here. I appreciate the love. Understand though, top 3 most biased trader of all time. Don't copy me. Not an investment professional. I do trade off stream. I don't guarantee anything. Understand CFTC 4.41 hypothetical or simulated performance have limitations, guys. Definitely shameless. Scared money doesn't make money. Yeah, but fearless money has no money. That's the best I could do. What's a good one? Fearless money. If scared money don't make money, what's the opposite of that? You risk too much money, down too big money. I don't know. There's some type of rhyme that we could get it from it. Hit me with your best one. The good thing about having a following like this is I can just ask you guys. Y'all are like an encyclopedia. Y'all are like my own version of AI. Hit me with your rhymes, guys. Dumb money loses money. Yeah, maybe that's good. Fearless money blows money. Yeah. Is 25 basis points good for crypto? I mean, we could look. Is it? Bitcoin's down. Not so far. Not so far. 25 basis points. And it makes sense why this wouldn't be good for crypto, because crypto is essentially competing with finance, big banks. And when people have cheaper access to money, i.e. lower interest rates, rate cuts, they need Bitcoin less, right? I'm not saying Bitcoin isn't useful, but that correlation makes sense in my head. So stock market's certainly not crashing here, guys. Come on now. Look, guys, look. Here's a daily chart. So just to clarify here, just this, guys. Look, here's a daily chart. Okay, this is all the way. This is 2024. So just to clarify what you're saying here, this is a crash according to you. I just want to clarify that. Is that a crash? You know? Of course not. We're not crashing. We might be dropping. Yeah, if you're too brave, you lose what you save. I like that. Shout out to Michael. I like that one. I kind of changed it a little bit, but I like it. Did you still say you think a Santa rally relief is in store? I don't know, right? Like, I have no freaking idea what the market's going to do. Market might go up, down, sideways. No freaking idea what it does. All we can do is speculate on it, and I really genuinely have no idea. I know a Santa rally happens 80% of the time, and we usually have a Fed decision in December. But whether it's going to happen this time, I have no freaking idea. Nobody does. We can speculate on it, though. Hey, thanks so much for the donation. I don't know how much that is. Let's look. Sometimes it's like these big, like $100, and then it's like 30 cents. What is that right there? Won't even let me click on it. Somebody help me out. How much is that? Honestly. Okay, I got it. Hold on. This is $1.18. Hey, thank you so much. I appreciate it regardless. Whether it's $1 or $100, thanks so much. Do you think Powell's going to talk about printing more money, or is it highly unlikely? He might talk about it, okay? But and I appreciate the donation. Thanks so much. But when we read the actual press conference here, okay, just so people understand like what they see. So you're talking about quantitative easing, Matt, right? So you're talking about QE, quantitative easing. Quantitative easing is a form of money printing in which it injects liquidity into the economy and tries to save us from looming recessions and depressions. We did it in 2020. It's one of the reasons inflation spikes so much, and generally it helps mortgage rates go down faster. And so maybe he's asking for context of real estate, but we're still doing quantitative tightening, the opposite of that. And if you read down here, the committee will continue reducing its holdings of treasury securities and agency debt and agency MBSs, right? And so what this means is that we're doing the opposite of that right now. They're still saying they're going to continue to do the opposite of quantitative easing. They're still doing QT, which is passive QT, letting their current holdings mature and run off. But they're still doing QT is what this means. I appreciate the donation, though. Thank you. All right, guys, we got 8 minutes left. 8 minutes. Okay. I appreciate the donation, brother. Andy, thanks so much. Yeah, do not fall. Is there a seed phrase? Let me delete it. Where's it at? Those have been getting bad. Do you see it anywhere? Is there? I don't see it, but if it's there, tell me who said it. I'll delete it. Oh, wait. I see it. Play game. Get banned for life, sir. Stop scamming people. Do not copy play. He's a bot. He's a scammer. Do not copy him. SPY 5% down or nah? I don't know how much SPY is down, but we're still not down anywhere close to a crash. Crash is like 30%, 20%. My first time watching, do you recommend learning to day trade now? I mean, again, most day traders lose money. And so you can learn to day trade. If you do, I think you should try a funded account program, but most day traders lose. And so regardless of where you go, you're probably going to lose, right? If you do trade small, trade with a funded account program, learn slow. Don't buy a course. Don't get wrapped up in some guru promising you riches. Most day traders lose. Nobody knows why the market's falling. No, genuinely nobody knows. All right, so again, guys, so we're gonna get ready to stream the full Fed meeting here. Yeah, so here's the Fed's projections here. This might be why the market's dropping. So in 2024, they think it's going to be 2.4 to 2.5%. In 2025, they think GDP is going to drop. 2026 as well, 2027. Unemployment rate, 4.2 to 4.5. Unemployment's going to get a little bit better, though, in 25, they think. Or no, a little bit worse in 2025. PC inflation is going to go down, though, which is good. At least it's expected to go down. Maybe a larger range. Core PCE is going to get better, too. Federal funds rate. So they think about they're going to cut rates in 25, some more, maybe pause. Market's bouncing back here, too. All right, we're going to get a couple different options up. We're just going to go with the fastest one. We're waiting for this one to start. We are live. We're waiting for it to start. It starts at 2:30 Eastern Standard Time, so we still got a couple minutes left. We'll put the NASDAQ up here. And we'll zoom in here if we need to, but we're just going to go with the fastest one. Yeah, the speech starts pretty soon. Yep. All right. All right, guys, you guys ready? Again, so we got a couple different sources up here. We're going to go with the fastest source, though, so stick around. All right. So we got both sources up. We're going to go with the fastest one here, chat. Fastest one. Again, we're too close to the meeting, so any big questions, we're going to have to answer it after the meeting. And so again, just understand that. Any big questions, we're going to have to answer it after the meeting's over. Again, bullish or bearish, hit the live button next to the play button. Make sure you're fully caught up on stream here, chat. I'm also going to mute the background music here so I can see when it exactly starts. Also, let me know how the sound is, right? As soon as we start the stream, let me know if the sound is good, bad, high, low, needs to get turned up some, because I can turn it up more. So just let me know. All right, so we muted the background music. And I'm going to turn this off. I turn my music off too. All right, so I'm trying to gauge which one's faster. I'm pretty sure I got one that's faster than this. So I'm going to make sure we get the most up-to-date one for you guys as well. I'm now going to lower the rate cut news banner. And then we're going to lower this thing too so you guys can really see the news. We also might zoom in if we need to. So stick around. There we go. All right, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were 2 simulations. One was seeing through, one was not. And I'd point you. There's some language in the in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then name some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not the That's not any decision that we've made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is, it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we've made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices, and that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight, but overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So, but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the Fomc really thought that the risks and uncertainty had improved relative to the labor market. And it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive? So
what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think it's 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continued struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the, you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you. Amara Mokoy from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that, and it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, big real wage increases so that their wages are going up, their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What % do you see and the committee believes, where is that neutral rate?
So I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent, and the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in and also how it's affecting the outlook. And it's not made any easier by the fact that, that our policy works with long and variable lags. Nonetheless, that is the job we have. And so I think it's appropriate for us now to proceed cautiously now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape. And these cuts will certainly help to support economic activity and the labor market while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering, what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected. You're talking about next year. Yeah, so headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level. all of those things should happen over time. And you know, those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. You know, but you're not wrong, though, that, you know, it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And, you know, I think if two years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, I'll take that. I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. You know, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, you know, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and you know, we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
All right, so that is the Fed meeting. So a couple things to talk about. Number one, don't go anywhere. We got a video breaking down our strategies coming out very soon. And so don't go anywhere. The other thing is, like, look, guys, like, people genuinely sensationalize the market way too much. Like, I get it. Bears have been kind of wrong a lot over the past, like, few years. I get it. It's also, like, an election year, and so they're even more emotional in years like this just because, like, you know, like, you got to understand this, guys. When in doubt, there's a very famous saying, and it goes, when in doubt, zoom out, okay? Like, let's take a look at this. This is the SPY, the S&P 500 over the past year, okay? Just in 2024, y'all are literally saying this is a crash. Like, guys, like, I get it. Like, what happens during election years, this is very typical. One side wants to make you think it's the worst it's ever possibly been, so you elect their guy, right? And so they put out all this stuff. Oh, it's terrible. Look how terrible things are. The other side wants to make you think it's the greatest it's ever been, right? So they put out all this stuff, and this blinds people that are really wrapped up in politics to think that we're just going to crash you know, the likelihood that we crash during election year, super freaking low. Super low probability of a market crash during election years. Yet every single Fed meeting, everybody screams market crash. It genuinely is just a sign that they don't pay much attention to, like, Fed meetings, right? Like, if somebody tells me the market's going to crash during the Fed meeting, it usually means they never watch Fed meetings and that they don't really understand what's going on. Listen, I'm not saying things are good. This is certainly like a pullback, but when in doubt, you got to zoom out. If I put up a weekly chart, it's going to look even worse than this for bears, right? Like, look, here's a weekly chart. This, like, you can't sensationalize things too much, guys. Like, you got to understand this little pullback is almost necessary. Like, we need to pull back here, right? It doesn't even mean the Santa rally is over. We might Santa rally as well. You never know, right? Tomorrow we have GDP. Friday we have PCE data. So we got a bunch of economic data coming out. It's just something which, guys, like, you got to be smart. Like, you can't call a crash every Fed meeting. Crashes are not very common. When they do happen, nobody usually knows they're going to happen. In fact, like, they romanticize The Big Short because it's so freaking rare that somebody can actually predict market crashes. Yet everybody and their grandmother wants to be the next big market crash contrarian predictor, and it's just not. It's a super low probability thing. Like, betting against the market long term is ridiculous. And the biggest statistical edge finance ever gives you in anything, guys, is that the market's going up long term, right? yet again, rookies mostly who watch Fed meetings for the first or second time end up just predicting crashes every single Fed meeting. It's just not common at all. It's not common at all. It's even less common during election years. And so you just got to be smart, guys, and understand, not get too influenced by like the people yelling crash. Like, this drop certainly doesn't look great, but it's probably a necessary correction here. And again, if you put up a weekly chart, it's nothing. If you put up a daily chart, it's still pretty small, right? Like, this took away some of the gains that we've made, but really we're still doing okay over the last few weeks, and a pullback is necessary. We broke lifetime highs yesterday, and so like things are going to pull back, and people just get too wrapped up in it. Yeah, if I put up the Q, it's probably a stronger chart too. Let me see. Yeah, so here's the Q. Right? Like, and again, you just got to understand, markets are going to go up, they're going to go down. You can't sensationalize it. You know how many people, listen, I'll put it this way. You know how many people told me the market would crash back here? Like, you know how many people told me the market would crash years ago and just crickets now because they're wrong? I'm not saying the market's never going to crash, and I think we might correct next year a little bit. But betting against the market long-term is a dumb rookie mistake. Somewhere, if you're betting against the market long-term, if you're trying to top pick markets and short Apple or short Amazon or short Nvidia, somewhere you've been misled, right? I'm not saying you can't make money doing it. It's just not the statistical edge you want it to be. And so I hope that makes sense, guys. Anyways, remember, guys, if you want to check out my sponsor, check out Top Step. We're going to be posting a video about Top Step later on today. So we got a video debuting today that's going to break down the strategies that I use in financial markets, right? So I've had a crazy good green streak in which we have basically we've been running about 80% accuracy recently, about 80%, right? In the video coming up, we're going to premiere it in about 2 minutes. In the video coming up, we're going to debut how we did it, what our strategies were, all that good stuff. And yeah, we'll see what happens. We'll see what happens. Yeah, who knows? Nobody knows. I don't know if the market's going to go up, down, or sideways. Chat, what I'm trying to tell people is, like, if you go to every FOMC meeting and you think the market's going to crash, it probably means you don't pay much attention to FOMC meetings. Is this drop good? No. But is it the worst thing we've ever seen? Of course not. Like, look at this drop. Like, look at this candle right here. This is the QQQ. Like, the Q was below this last week, guys. Like, look, here's last week, you know? So just, you know, again, if you find yourself predicting a crash every other week, you got to see signs like GDP at 3%, unemployment under 4.5%. Like, you know, it's just not the super weak sign of a crash or correction that we need. If anything, guys, I talked about this before. If we do crash, it might be AI correction. I would watch Nvidia. You know, Nvidia's had a kind of a weak couple weeks. I would watch Nvidia. People are talking about the Dow. The Dow is not as diversified though. So if we look at the Dow honestly looks to be like, so people are talking about the Dow. Look at the Dow right here. So like, are y'all going to tell me y'all can't see this trend right here? Like, look. Can y'all really not see that trend on the Dow? Like, look at this. Does that not look like a reasonable trend? Maybe this line's a little off. Hold on, let's see. Anyways, does that not look like a trend to you guys? That looks like a trend to me here. Look at this. No? Like, come on now. We could act like this is the end of the world on the Dow, but I think people are just desperate to predict a crash and be the next big contrarian predictor. Maybe I'm wrong, though. I don't freaking know. I'll see you guys later. Again, as soon as we close this stream, it's immediately going to go to this next video that we have debuting here. So we're going to be debuting this video, guys. It's going to be right now. Yeah, we're going to be debuting this video. I'll see you guys over there. Again, we're going to premiere straight to this video. I'll see you guys over there. Good luck. I love you all. Y'all have a great day. Tomorrow, we got GDP data, PCE data on Friday. We will cover it all live, as we always do here, guys. So I'll see you guys over at the premiere. If it doesn't bring you to the premiere for whatever reason, go to this link. Here's the link to the premiere. Okay? So, we're going to talk about day trading strategies. We're going to talk about day trading strategies. Here's the video premiere for it. Again, if it doesn't bring you over for whatever reason, there's the link right there. Check it out. Yeah, all good, David. Y'all have a great day. Yeah, they just want to be the next big contrarian, but it's just such a low edge thing that like everybody gets wrapped up in it. Nobody can really do it, and then they just end up yelling manipulation when they're wrong or something. You know what I mean? Like that's what happens most of the time. But yeah, I'll see you guys over there. Good luck.